this year, and something that we may not see ever again in our lifetimes. There's been so many things going on, but just a couple of trading days left in the year. And of course, we didn't have a trading day on Friday, but Monday through Thursday saw a lot of movement.
Absolutely. And we came in on Monday on COVID fears, concerns about the Omicron virus. And then throughout the week, we got good news. We heard about therapeutics that seem to work. We know the vaccines, or they seem to think the vaccines tend to work as well. We've also heard that hospitalizations have collapsed in South Africa, where it was initially found. So the initial terror and headline-driven investing that caused a sharp pullback post-Thanksgiving and even into early this week have subsided.
Yeah, there's no question. You look at where we are in the S&P 500 at 4,700, and of course that has been one heck of a ride. And a lot of people are starting to make projections of what 2022 would look like, and we're seeing numbers around 5,000, certainly much more muted in 22 than we saw in 21.
And history shows, that the analysts tend to assume about an 8% year-on-year return in the S&P 500, which is roughly the historical average, but we rarely finish there. Usually it's either a lot better or a lot worse, mostly a lot better. And going into this year, the consensus is it's going to be a much more difficult year. There will be headwinds like the Fed, higher prices and so on, and valuation. But who's to say? As Warren Buffett said, the rearview mirror is always clearer than the windshield.
That's right. And so one of the things that we're going to look for 2022 is really inflation and the Fed's reaction to inflation. Certainly, we had talked about how we thought all year long that the inflation was not transitory. There's just, out of the definition of alone, we thought there were going to be stickier parts of that, and I think we got that right.
Right. I mean, we're starting to see rental prices start to increase, which affects CPI. We're seeing wage growth, although wage growth is less than the rate of inflation, so real wages are not growing. And historically, during tightening cycles, while the initial 3 months after a Fed rate hike tend to be a little bit sideways in terms of stock performance, 6 months later, the market tends to be higher. And that's usually a reflection of a strong economy.
And so what we're going to look for, of course, we've talked about this a lot throughout the year, is the tapering process has certainly begun. And by March of 2022, the taper will have been completed. In other words, the Fed will stop flooding the economy with trillions of dollars. And at that point, likely start raising rates. There's a lot of economists out there that are talking about 2 and 3 rate hikes in 2022, and that will be the story.
Right. And, historically, the market tends to overestimate what the Fed's going to do. People say, the Fed's going to raise rates ad infinitum, or we all know long-term rates are going up. Well, guess what? They went down this year despite an economy that grew rather dramatically. So I always hesitate to predict where long-term rates are going to go. That's the bond market's job, and the bond vigilantes will pay attention to what the Fed's doing and perhaps discount a Fed policy mistake.
And that's really the most concerning part. And we do watch the bond market because, of course, the Fed looks backwards on the facts and circumstances that they actually have and not forward what the bond market does. They try to anticipate what could happen. But the terms that we saw throughout the year, supply chain bottlenecks, inflation, and labor shortages were with us, and that caused inflation, which certainly was the story. Now, 2022, Derek, means that interest rates are going to affect pricing of all securities.
They will. And, when you discount a cash flows of a business, depending upon its growth trajectory, can have a very large impact or a very muted impact. So, for example, if one were to believe that long-term rates are going to move higher next year as the Fed hikes rates, then things like financial institutions ought to do extremely well. Real estate ought to do very well. If, however, they raise rates really quickly, those high-octane growth stocks will get crushed.
And more importantly, Derek, you think about, will there be a reversal? Because in a low-rate environment, people went from treasuries to corporates, from bonds to stocks, defensive stock ideas to speculation. There's a possibility that reverses.